This is Al Brooks. Thank you for watching the Brooks Trading course. This is the first of 3 videos on trading major trend reversal bottoms. A very important point about bottoms is that you need to see some evidence that the bulls are strong. Also, it's easier to trade a bottom if you're anticipating it before the signal actually triggers. And finally, there's a difference between a major reversal, in which you're looking for an opposite trend, and a minor reversal, which usually becomes a flag or a trading range. This is a 60-minute chart of the euro versus the dollar, and I want to talk a little bit about a lower low major trend reversal. When the market's in a bear trend like this, traders assume that every reversal attempt is minor and that it will be followed by a resumption of the bear trend. Even after a fairly strong reversal like this, it's only a couple of bars, traders assume that the best the bulls get is a trading range and the bear trend will resume. At some point, you get a break above the channel. The minor reversal has a lot of bars and several strong bars. Once that happens, traders still assume the bear trend will resume. However, when you get pretty good buying pressure in that minor reversal, traders begin to wonder if the next reversal will be major. For traders to begin to look for a major reversal, they want the final minor reversal to have at least 5 bars, maybe 10 bars, and they want to see some pretty good bull bars within it. They want the minor reversal to break above the moving average and above the bear trend line. And at that point, there's a 40% chance that a reversal, instead of being minor, will in fact be major. Here, would they buy above this doji bar or above that bull bar? Well, it's a 6 or 7 bar bear microchannel, no pullback. A lot of traders would wait for a second entry buy and preferably above a bull bar. Here's a second entry buy, but not above a bull bar. Here is another buy, and this time the bulls have a bull bar for their buy signal bar. This is a reasonable buy setup. You have a slightly lower low below the bottom of the bear trend, and you have a double bottom, lower low, major trend reversal. 40% chance that you're going to get a swing up. By a swing up, typically traders expect at least 2 legs and 20 or more bars, which they got in this particular case. Rolls strong enough to break above the bear channel and above the moving average. We have a gap bar here. The low of this bar is above the moving average. Therefore, there's a gap between the low of the bar and the moving average. That means the bulls were strong enough to put a bar completely above the average price. When that happens and the bear trend resumes, usually there's an attempt at a major trend reversal. 40% chance the bulls will get a swing up. Gap bar, gap below the low of the bar and the average price. This rally, some traders will look at it as a wedge bear flag, with the first push being here, second or third. Other traders will look at it as a double top bear flag, low 1, low 2. And now we have a wedge lower low for a wedge bottom. And that increases the reliability of a reversal up. Traders will buy the lower low major trend reversal. These lows are below the low of the bull trend, and it's a second entry. Here's a first, maybe above that bull bar, and here's a second above this bull bar. Whenever you get a lower low major trend reversal and you get a strong reversal up, you almost always get a higher low major trend reversal following that lower low. This strong reversal up is so strong, the odds are we're in a bull trend, and therefore every reversal down, even if it lasts a lot of bars like this, will probably be minor, and the odds are there'll be at least a rally back up to the old bull trend high. Therefore, this is a higher low major trend reversal. After pretty good buying pressure late in a bear trend that is weakening, starting to get a lot of small sideways bars, you have to expect that the bulls might take control, at least for a couple legs sideways to up. Higher probability of a successful bull reversal if the final sell-off to test the prior low is weak, and if there's some other pattern going on, and here we have a wedge lower low. If the sell-off testing the prior low is strong, as it is here, a lot of traders will wait for a second entry, especially one where there's a good buy signal bar, as there is here. All of that increases the probability that the bulls will be able to take control, or at least get 10 bars, 2 legs sideways to up. 40% of the time, you get an actual strong reversal up, as we did here. It's always higher probability if you have a good buy signal bar. Here, not a very good buy signal bar. There's about an 8-bar bear microchannel, no pullback for 8 bars. And the bulls only have a doji. Here they have a little bull bar, but it's still a very tight bear channel, too much selling pressure. A lot of bulls will wait for a better looking buy signal bar, or at least some kind of a double bottom and second entry. When you take the buy, the market's usually still always in short. We're still in a bear trend. We're still getting lower lows and lower highs. And that means that it's more likely the market's going to go sideways to down than it is that the market's going to reverse up. And that's why the probability of buying a major trend reversal is only about 40%. Only about 40% chance of getting a reward at least 2 times bigger than your risk and a swing up. How can you make money if you're taking a trade that only has a 40% probability of success? Well, you make money because the reward is many times greater than the risk. And that great risk-reward ratio more than offsets the relatively low probability, and the result is a positive trader's equation. Once you have a strong breakout, or a very strong breakout, the probability of making money goes up. It goes up to 60%. However, then your stop is further away. So if you buy here, your stop is still down here, and now it's further away. And therefore, you're getting higher probability, but you're getting a worse risk-reward ratio. And that's always the trade-off. You cannot have both a very high probability of success and a very good risk-reward ratio. That would be a perfect trade, and it cannot exist because everyone would take it and no one would be left taking the other side. You can either take profits all at once, or you can scale out of your trade in 2 or more steps. Because the probability is only 40% of making a reward that is at least twice your actual risk, you have to make sure that you hold the trade for at least 2 times your actual risk. Now, when you look at this trade, you buy above this bar, your actual risk is tiny, only a few pips. And do you want to be exiting with 2 times 2 pips? Let's say your actual risk is 2 or 3 pips. Do you want to take 4 or 6 pips profit? Remember, the minimum profit that you should ever consider when you're trading Forex markets is 10 pips. And therefore, if the risk is only 2 pips, yes, the minimum reward is 2 times that, 4 pips. However, it also has to be bigger than the minimum scalp size, which is 10 pips. So you cannot take profits here at simply 2 times actual risk. Your initial risk, you buy above this bar, you get filled here. Your stop is below the low of that bar. And your initial risk might be, I don't know how big that bar is, but it might only be 5 pips tall. And then 2 times your initial risk is then only 10 pips. And Do you really want to be taking 10 pips profit when some of the bull bars are 20 pips or more tall? You're betting on a major trend reversal, and therefore you're betting on other bars that look like this, and probably 2 or 3 or 4 of them, and therefore that profit is too small. Actual risk is from your entry price to below the low of this bar. It never traded below that bar after you entered, and therefore that's how much you actually risked on the trade. It's really helpful, I think, if you anticipate a possible bottom and then you're ready to place the trade and to manage it properly. Here, the actual risk is very, very small. When that's the case, it's usually better to think about a profit in terms of initial risk. Initial risk is from your entry price to your stop, which is below the low of that bar. That's the height of your initial risk from your entry price to your stop. Two times your initial risk is right here. Do you think that's a reasonable place to take profits? Well, it's probably okay to take partial profits, but I would not take off an entire position. This is a very strong bull bar, and chances are, after a major trend reversal with a very strong breakout like this, you're going to get at least a second leg up. Every day, late in the session, here's late in the session, day traders will look for reasons to exit trades, even trades based on the 60-minute chart. They might take partial profits below here or here, and then here is another day, and we're starting to get deeper pullbacks, some selling pressure, and we're testing this old high. So it's reasonable now to consider taking profits. We have a double top, maybe a wedge, 1, 2, 3, and then testing a prior high. That is a reasonable location to take profits. And you can see if you took profits up there, you made about 150 pips or so, and that's far greater than if you had taken your entire profits at 2 times initial risk. When you're swing trading and you get a really good move early on, it's better not to be too quick to take profits. If you're able to take partial profits, it's reasonable to take partial profits, but if you're able to hold at least part of your position, it's usually worth doing that. Anytime I see a bear channel, there's a 75% chance we're going to get a bull breakout. So I equate a bear channel with a bull flag. Remember the market cycle. The market has a breakout, a strong trend phase, a channel phase, and then it transitions into a trading range, usually testing the top of the channel. Even though the bull's got to swing up here, usually a major trend reversal ends up evolving into a large trading range. The bulls are looking for breakouts above prior lower highs here, 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 all the way to the top of the channel. Bear breakout and a channel. And you can see when we got near the top of the channel, traders started to take profits, betting that the channel would evolve into a trading range. Channels often have 3 pushes down. So we have a channel with a first push, a second push, and a third push. So instead of calling this a lower low major trend reversal, some traders might call it a wedge bottom. I would call it more of a major trend reversal than a wedge bottom because the channel is so tight. And I don't like to trade wedge bottoms when the wedge is a very tight channel. This is an undershoot. It's very common when you have a wedge for the third leg to not reach the trend line or go below the bottom of the channel. So an undershoot or an overshoot. In any case, you have to be prepared for a reversal up. Channel here is too tight to take the first reversal. This is a second reversal. Plus, I think it's a reasonable candidate for a lower low major trend reversal. Again, when the wedge is a fairly tight channel like this, I tend not to trade it as a wedge. I tend to think of it more as a major trend reversal. Whether you traded it as a wedge or a major trend reversal, your entry is the same. For me to trade this as a wedge reversal, I really would like the legs up to be bigger. And I'd like the sell-off not to have as many bars as it has. In other words, I want a much broader channel. This is, I think, relatively tight. First leg of a potential wedge. You don't know at this point that this is the first leg of a wedge, but it lasted only 2 bars. Not very strong. But it was followed by about 20 or 30 bars in a pretty tight range, and therefore the bears were not very strong. The bears allowed a big bull bar, and they were unable to resume the bear trend for about 20 or more bars. It's possible that this is a higher low reversal, but with this channel as tight as it is, even with this big bull bar, it's just not enough buying pressure. So this is probably going to be a minor reversal, leading to a bear flag and a resumption of the bear trend. This is probably not enough buying pressure for traders to buy a higher low or a lower low major trend reversal. Very tight bear channel, so probably not a lower low major trend reversal. Bulls might look at this as a bear trend, a bull breakout, and then a lower low major trend reversal. I would not. Too many bars down and the channel is too tight. I think the bulls need to start the process over again. They need another breakout, preferably with good buying pressure, and then look for a reversal up. Again, a very tight channel here. A lot of bulls, most bulls would not take the first reversal up, but now we're starting to go sideways, so the bears are losing strength. They lost a lot of strength here as well. It's a tight channel, but a lot of the bars are very, very small. And here we've had multiple reversals with good reversals up by the bulls. And now the bears have a new low, but they're stalling. This is a reasonable buy for a second entry on the lower low major trend reversal. Final leg down for the bears is weak. It's mostly a tight trading range. There are bear bars here, but a big tail below, a bear bar and then a reversal. So the bears are losing control. Bear bars, reversal. A lot of times when you're looking for a bottom, the final leg will be extra strong, climactic. It can be 4, 5, even 10 consecutive bear bars, and then you get an abrupt reversal up. Here, there's a 6-bar bear microchannel, pretty much the strongest attempt by the bears in 30, 40, 50 bars. And whenever you see greater strength late in a trend, it's more likely an exhaustive end of the trend than a resumption of an even stronger trend. However, it's a strong enough sell-off so that the bears will probably get one more leg down, and therefore I would wait for a second reversal up before buying. All trends are constantly trying to reverse, but most reversals fail. They become bear flags, and therefore they are minor. They do not lead to a reversal of the major trend. Remember, when you're in a bear trend, every rally is a small bull trend. Small bull trend, but these are all minor bull trends. that are bear flags, and you expect a resumption of the bear trend. When you get a very tight bear channel like this on the next higher time frame chart, like a 15-minute chart, this is a 5-minute euro versus the dollar chart. This is simply a breakout, maybe 3 or 4 consecutive bear bars on the 15-minute chart. When there's that much selling pressure, it's better not to look to buy. A lot of times beginners will look at this and say, wow, we got a good bull bar here, we got another bull bar here, and now we got another bull bar here. Maybe it's a major reversal and maybe we'll get a bull trend. While that sometimes happens, usually not. When the bears are strong enough to have a very tight channel like this, the first reversal up is usually minor. It becomes a bear flag. However, if the first reversal up is strong like this, traders will look at the next reversal up as a potential major reversal. Is this a high or low major trend reversal? I don't know. It might be. We got a bull breakout here. The rally has 1 bar, 2 bars. It only goes up for a few bars. I don't know that that's enough buying pressure to totally reverse this. While this is a high or low major trend reversal, I think the probability of success is less than 40%. Now we broke to a new low. Is this a lower low major trend reversal? Well, I don't know that there's enough buying pressure yet to get a major reversal. And then this channel is very tight. Even though we have a double bottom, we do not have a good buy signal bar here. This is not a good buy signal bar with that big tail. This is probably going to be another minor reversal. Remember, bear trends are constantly trying to reverse. Traders look at the reversals, and it's very easy to talk yourself into believing that it's a major reversal. But you really have to assess the relative strength of the bulls and the bears. When the bears are this strong, you need more from the bulls than this to get a major reversal up. An expert trader looks at this and says, yeah, maybe this is a major reversal. It's probably firms taking partial profits. After such a big sell-off, their stop is now far away. That means the risk is greater. They reduce their risk by taking some partial profits. And that's mostly what's taking place here. You have some bulls who are scalping, but not many bulls willing to hold on to positions. As soon as they get a quick profit, the bulls will sell. And the bears will put their position back on again, right at the moving average. We're testing the breakout point. And we have 2 legs up, 1 pullback 2. So this is a low 2 bear flag at the moving average, not a major reversal. Traders will look to sell reversals down from the moving average. Strong reversal up, low 2 short, low 1, low 2, traders sell. Strong bull bar at the moving average, traders will bet the reversal will fail, they'll sell. We have another test of the moving average here. They'll be selling below the bar. Here we have 2 decent bear bars, 4 or 5 bars without a bull body. They'll sell below that bear bar because it's near the moving average. Another reversal up near the moving average, a bear bar, they'll sell the reversal down. Even here, experienced traders will look at this and say, yeah, gap bars usually lead to a resumption of the bear trend, not a reversal. And even though the bulls are getting pretty good buying pressure all through here, they'll still sell the reversal down. However, gap bars, and we're starting to accumulate a lot of good bull bars, they expect the gap bars to lead to the final leg of the bear trend before a reasonable reversal up. Some traders don't worry about picking an exact bottom. They use wide stops and scale in lower. There's less stress that way if it suits your personality, if you can do that. Good buying pressure, pretty good bull bars. We're late in a channel. Probably we'll get a swing up soon. Probably not much more down before we get a reversal. This might be the final bear flag. Some bulls will start buying. they'll buy a reversal up, they'll buy below bars, betting that the sell-offs will not get very far. The traders who do that are going to use a wider stop. I like to base my stops upon some kind of a measured move. The bulls are trying to get a reversal up here. We got a bear breakout below it. Maybe we'll fall for a measured move down. Therefore, a reasonable place for a stop is just below that measured move target, maybe 5 pips below. And you can see what happened when we got to the measured move target. We reversed up. It's also at the bottom of the channel. The bulls who bought here and who did not stop themselves out here, and they used a wider stop, were not stopped out, and they were able to make a profit. A lot of these traders will trade small, and if there's a new low that reverses up, they'll buy more, and they'll increase their position size. Some will take partial profits at their original entry, so they get out break even on this buy and that buy around here, and that leaves them with a lower entry. This is a 30-minute chart of the euro versus the dollar. We have a bear trend, pretty good breakout, and then a second leg up here. And then the bear trend resumed. And we have a first attempt up and a second attempt up. It's reasonable to buy this as a lower low major trend reversal. 40% chance you'll get a swing up. 60% chance you'll get a small profit or a small loss. Whenever you get a lower low major trend reversal, you usually end up getting a higher low major trend reversal at some point, 10 bars later, 20, 30 bars later. And this is slightly a higher low. We have a lower low major trend reversal here, no significant rally. And now we have, if you want, you can call it a double bottom, you can call it a slightly higher low, but it's a second entry buy. The bulls who did not buy this, maybe because it's a very tight bear channel, will look to buy a second entry, either here or above here. The bull trend needs a series of higher lows. The bulls who bought here, their stop is below the low of this bar. Anytime the market reverses up from a higher low above this low, they look at it as an opportunity to buy again, betting that we'll start to get a series of higher lows and a bull trend. Traders always ask me if there's a best setup, best trade. Every one of these bars has big volume. That means institutions are buying and selling constantly all the time. And they're doing that because they see opportunities all the time. And therefore, there is no best entry, and it's never too late to enter a trade. Every market, every bar is an opportunity to do something. The later entries are just as good as the earlier entries as far as the trader's equation is concerned. They have greater risk but higher probability of profit. And that's just as good mathematically as an early entry with very little risk but lower probability of profit. No matter where you enter, and for whatever reason you enter, it's usually good to hold for at least 2 times actual risk. That usually results in a positive trader's equation. If the actual risk is tiny, then hold for much more than that. These are all reasonable buys. Strong bull breakout, you can buy the close. An attempt by the bears to reverse down, you can buy the low. We're well above the moving average. Here we have a small high 2 buy above the moving average after a bull breakout. You buy above the high of that bar. The bears are trying to reverse down. You can buy at the low of that bull bar, betting that the bears will fail. The bulls are reversing up again. You buy above that bar. Now we're buy closes. A bear reversal attempt after 4 or 5 strong bull bars. You buy at the low of that bar, betting the reversal will fail. And we have a bull bar here for a high 1 buy. You buy above that bull bar. I made the important point early on that if you're looking to buy a bottom, You need some sign that the bulls are strong. You need bull bars. You need buying pressure. Also, I think it's very important to anticipate bottoms. If you're planning on taking a bottom, try to anticipate it before it happens and try to decide where your stop would be, where your profit targets would be. Look for prior lower highs in the bear trend as possible targets for the trend reversal. Also think about measured move projections. Bear trends are always trying to reverse, but most of the reversal attempts are minor. Therefore, be careful buying minor reversals because they usually become bear flags and the bear trend usually resumes. I'm Al Brooks. Thank you for watching the Brooks Trading Course. This is the first of 3 videos on trading major trend reversal bottoms.